Even with today's rally, Wall Street's biggest bull says the market is still on sale. Jonathan Golub is a chief U.S. equity strategist, head of quantitative research at Credit Suisse. Jonathan, great to have you with us.
Good to see you.
What happens when the Fed, let's say, just for argument's sake, at Jackson Hole, starts saying, we're going to start thinking about, or we're going to actually, curtail buying bonds? What happens to this market? Are you still bullish?
Yes, I think we are. I mean, we're seeing an enormous amount of stimulus. I mean, at the end of the day, this story is all about exploding earnings. Consumers have an enormous balances in their checking accounts, whether they got money from the government, whether they just didn't have the ability to spend, whether their portfolios were up in value. And that is going to be unleashed as we're all vaccinated and get into the summer. We're all told we can go back to work. So that's a huge positive. The fiscal spending is not over, and we are meaningfully underestimating the earnings with record level type beats on earnings announcements. Mm-hmm. So do I want to see the Fed renormalize? Yeah, I actually would like to see things kind of get back to something that's a bit more normal, because what we've seen is just, unbelievable levels of stimulus that ultimately ends badly.
In terms of the stimulus, though, and you mentioned the sort of, the good effects of stimulus immediately, at least within the economy. When it comes to fiscal spending, that will come. If we have increased fiscal spending, that will come with tax increases, whether it be on the corporate level or on the individual level. When it comes to some of the individual stimulus programs, at least 21 states have opted to end federal unemployment benefits early. How does that factor in to your view of the markets?
Yes, it's interesting that if you look at just, let's say, the corporate tax that we're talking about, which let's say that Biden gets exactly what he's asking for, which is a move to 28% on the corporate tax, that would shave off about 6% off of profits. So let's just assume that that's basically what you would see as a hit to stocks. However, companies are beating by 22% this past quarter. And so we, for example, increased our earnings estimates for next year from basically $210 of profits on the S&P to $225. And then when we took it down for higher taxes, we took it down to $215. So we actually increased our earnings estimates, including this tax, because the numbers are coming in so strong. So in general, I would be, somewhat concerned about the hit from taxes, but it's just being overwhelmed by how strong the economy is. And let's call it what it is. We have an overheating economy that ultimately is going to end badly. And so the fact that the Fed may take their foot off the gas a tiny bit should not be a concern to anyone.
Hey, Jonathan, Jeff Mills here. I just had a question about market leadership. Obviously today we saw this big reversal based on, what had been working and what was working in 2020. Looking forward, whether it's the Fed talking about tapering, whether it's risks on the policy side, how do you see the complexion in the market developing in terms of leadership? Where do you really think you want to be?
Right. So let me start off by saying that I'm a growth guy. I think over the long run that growth stocks are going to win. I think over the long run, the U.S. is the best market in the world because we are the innovation capital of the world. For the last 10 years, I've been almost, overweight growth almost the entire time. This is the first time in a long time that I've basically said, run this value thing really hard. I think that the cyclical trade, and I think it was Guy who may have been mentioning this before, I think the cyclical trade has between 2 and 5 quarters more to go. I think banks look probably more attractive than any other group. I think that energy and materials and industrials and basically old economy stocks, they do really well in an overheated economy, which is what we're seeing. So this doesn't last forever. And I'll be back on here talking growth, but not yet.
And Jonathan, when you say the market is on sale, what metric are you using, and at what point would you say, even if you say things are going to run for 2 to 5 quarters, I mean, if things run really fast, really hot, then you might say, it's time to pull the ripcord. So what sorts of metrics are you looking at?
Yeah, I'm just looking at something as simple as PE multiples. And,
okay.
And here's a mistake that people make. if the market's up 30%, people say, wow, the market must be expensive. But if at the same time the earnings were up 40%, then the PE multiple fell. In August, we had a PE multiple in the market of about 23 and a quarter. And today we have a PE multiple that's around 20.5. Maybe with today it's closer to 21. So the market is about 2 or 2.5 multiple points cheaper since last August, even though the markets run like crazy.
Yeah.
And so the issue is that the P in that PE formula is just having a hard time keeping up with how good the E is. When does the earnings when does the valuation become an issue? It's when the earnings start to slow down. Then that's a whole different story.
All right, Jonathan, great to have you. Thank you.
Shepard Smith here. Thanks for watching CNBC on YouTube.